Unfortunately, the CPI number came in with inflation much hotter than we wanted it to be. Overall, the mortgage-backed security market is not happy, and neither is the stock market, with the Dow Jones down, last I checked, about 970 points, and the mortgage-backed security that we're watching down 53 basis points. So we are having a tough day. Let's look at this CPI report here and find out what is going on. And I'm going to show you the key ingredient that is really kind of hiding the truth of what's happening here. So welcome back to the Brent Bruce Daily. Today is September the 13th, 2022. It is now 1:19 p.m. Central Time, and there is so much going on that we need to get to. Make sure that you like, subscribe, and share the YouTube channel if you like this content, because we will be getting away from our BombBomb subscription and pushing everybody over to exclusively using the YouTube channel here in the near future. So as you see here, the headlines all over the place is that inflation is just out of control. And we're talking a lot about fuel and energy here. So let's take a look at the breakdown of the overall numbers here. Again, this is compliments of our friends over at MBS Highway. They put together the charts for us here. So the consumer price index is made up of two different components. There is the headline number, which is kind of the all-inclusive number of this report. And then there's the core report. And the core report excludes food and energy. Why would we exclude food and energy? Because they see those two components as being so volatile that they like to say, well, if we were to take those two out, then where do we land? And unfortunately, it's not good no matter where we look. But unfortunately, the gasoline piece is really the key. And I'll show you why the numbers are a little different than they really truly should be. So month over month, the headline number is up 0.1. But we wanted it to be down 0.1. We wanted inflation to subside a little bit and be down 1/10. It was actually up 1/10. That is a 0.2 difference. Okay, so keep that in mind. Year over year, we were at 8.5. We dropped to 8.3% year over year headline consumer price index. We were hoping for it to be at 8.1. So the fact that it came in at 8.3, it's hotter than we wanted it to be. Now look at the difference here. 8.5 to 8.3 is 0.2, right? Which coincides with our monthly numbers. Now, how could month over month inflation be up, but year over year inflation be down? Because you look at the past history, and August of 2021, the month over month number was higher than 0.1, and we're getting rid of that number, replacing it with this number, which is actually what brings the year over year number down. We'll get into that further on another time. Now, the number that we're really looking more closely at is the core CPI numbers. The reason, again, is because we're going to exclude food and energy. Food, we know, is very volatile. And here's the other thing. Energy, essentially, it's gasoline, right? So we know that gasoline prices have been more than volatile. We were up to all-time highs, and now we've come down quite a bit since then. So you see that gasoline is down 11% on the CPI month over month. Well, of course it is. We all know that gasoline prices have come down considerably. But why is that? It is because the federal government has opened the strategic reserves to try to get gas prices down. So essentially, we have tapped into our gasoline savings account and started using something out of savings to try to help us in the immediate term, not thinking about the long term. Now, that can't go on forever. And as a matter of fact, they're expecting to stop pulling gasoline from the strategic reserves at the end of September. So if all of a sudden the strategic reserves aren't supplementing our gasoline prices, are we going to see gasoline shoot back up to where it was before then? Well, then we wouldn't have a month over month reduction in 11% on food and energy. So the energy portion of that, which would make our headline number even higher, and our core numbers jump back, our headline number jump back even higher. So you would have seen the headline numbers probably more like up 0.3 or up 0.4 if you didn't have gasoline being supplemented by the strategic reserves. Okay, so you have to keep that in mind, because every other aspect of this report was very, very high. Food prices, again, if we're talking about food and energy, food was up. That means that energy had to be so down to actually make a negative impact. Food was up, but gasoline prices have come down so much that is what is skewing the numbers. And we know that's going to stop soon. Okay, that's the concern. Food prices were up 0.8%. Month over month, guys, do the math, multiply that times 12. Rent up 0.7%. Well, probably when you think about it, we're like, no, rent's up more than that, right? Rent's up 15, 18, 20% year over year. This is saying 6.7%. Well, we know inflation is out of control. And the consumer price index numbers confirmed that. That is why the markets are not happy. And we know that inflation is the arch enemy of mortgage-backed securities, bonds, and therefore home loan interest rates. What does that do to our home loan interest rates today? Let's look at the Brent Bruce Daily Report. Remember, we were about 5.875% yesterday when we took a matter of fact, we didn't look at the charts because I was on the road, but I told you we were about 5.875. Now, after the CPI report came in ugly, and we talked about it, if it came in ugly, we would have a problem. We are now at 6.125%. That is 0.25% swing in rate, not in cost, but in rate in one day because of the consumer price index being at 0.1 instead of negative 0.1. It doesn't seem like a lot until you start understanding what these numbers really mean and how they affect the economy. Okay, so 0.1 to negative 0.1 has made the stock market, the Dow Jones Industrial Average, drop 970 points, and interest rates go up by 0.25% on home loan interest rates in a single day. Now, normally we do have a knee-jerk reaction. I talk about that often. So we may see things start to subside, and maybe we'll end up with the interest rates only going to maybe 6 instead of 6.125, either by the end of the day or maybe tomorrow we'll see a little bit of a response. Now, we're going to go a little bit longer here because I want to show you the charts. Here we are. We're down 50 basis points. We know that is an ugly day. The 10-year is up 7 basis points. Not too terrible, but not good. Look at the charts, okay? Remember all these numbers we've been talking about over the months? Remember when this was giving us a 4.625 interest rate? And then we talked about when we were hitting that triple floor of support at one point. All these different things that have happened over the past few months. Look at how we have just gone through all of these floors. Now we break through this. Now we break through this. We were all the way down into this range at one point. What does that mean from a long-term perspective? Well, let's take a look at 2 years out, a chart for 2 years. Look where we are. And remember, down is bad, up is good, okay? So over 2 years, we're not even in the range of where we were. We are now tremendously down. Do you know what happened about this time here? Let's say January of 2022, February, March. This is when the Federal Reserve stopped saying that inflation was going to be transitory and that it might actually be something that we are going to need to deal with in the long run. And the inflation numbers really started to come out. That is what happened. And that is when we started to see things really drop. Okay. And then, of course, we all know that most recently on August the 16th, the Inflation Reduction Act came out, which is terrible. And that has really pushed us even further down. So let's go even further out. Like, what if we try to go out longer time frames? I mean, let me see how far I can get this out. If I can get it out like 5 years or something like that and see where we are. So this is October of 2019. Okay, so now we're going back 3 years almost. Okay, and you're seeing that we are way down here, where previous to this, we were most concerned with this floor of support here. I mean, we've broken way below that. So this is just, I'm showing you this because this is the effects of inflation. This is the effects of the government putting $5 trillion into the economy. Too many dollars chasing too few products. Go back and watch my videos if you want more information on that. Inflation has pushed us into this range here. What do we think is going to happen in the future? Inflation will subside. The Federal Reserve on the 21st is going to increase the federal funds rate by at least 0.75, maybe 1%, which is going to be a welcomed thing. If they go 0.1, the mortgage-backed security market might really like that because we need somebody to come in and put a stop to this inflation and really make a decisive move. 0.75, I think, is what's going to happen because they also have to be careful of how the stock market interprets things in the overall economy, not just the bond market and the mortgage-backed security market. But we will definitely see what they do. The 21st of September will be the next Federal Reserve announcement. That's going to help us out. We'll have to see how things go in the future. Hopefully, we'll have a knee-jerk reaction today and we'll start to bounce back a little bit and recover. I will keep you posted. I know we went long, but this is a big day. Make sure that you like, subscribe, and share. Let me know what questions you have. I'd love to talk to you. Thanks.